As traders, we want to win every trade, and we try to win as many trades as possible. And many traders focus on the win rate, win ratio as a key statistic. But what if being right isn't enough? And the truth is, you can only win half of your trades and be a very profitable trader, and you can have a very high win ratio and still end up with a net loss. Hi, I'm Dean Jenkins with Follow Me Trades, and this is episode 3 of my series that I'm calling It's Not a Chart Problem. And today's episode is called Why Being Right Isn't Enough. So let's have a little fun with Excel, and I'll do a demonstration here. All right, so I've put together this Excel sheet, and it's what's called a Monte Carlo simulation. And I'm using the random functions in Excel to simulate trades. Now, it's not a perfect market behavior representation, but it's I think, an excellent math demonstration. So just real quickly, we're gonna assume a $50,000 account with a 2% risk per trade, meaning the most we'll lose on any given trade is 2% of the account. We're gonna put the max win at 1,000, max loss at 1,000, and a win rate of 60%. And down below, I'm sampling 50 trades each time I cycle this. So there's a 60% probability that any given trade will win. And then if it wins, then there's a random assignment of the win between $100 and 1,000. And if the trade loses, then it's a random decision. Is it a loss of 100 or 1,000? Okay. So at the end, after we sample 50 trades, it tells you what the P&L was for the run. So I can click this several times. I can just cycle the chart. And you can see there we did 50 trades, and with a 60% win ratio, with a 1-to-1 payout ratio, we lost $600. So just keep watching this P&L number here. That one was good, 5,000, 6,000, 4,000, lost 2,000, made 2,000. Okay, you can see pretty wide variability, and occasionally over 50 trades a net loss. Now, what if we maintain the max loss at 1,000 but change the max win to 2,000, which gives us on average a 2-to-1 payout ratio? So I'll cycle it. There's a $20,000 win, 14, 21, 16, 30, 22, 17. So you can see much more profitable, and I can cycle this 100 times. I've done it. We'll see some variability because the market's variable. We will never see a net loss. So you may say it's easy to change on a spreadsheet, but we can actually do this in our trading, where we can take trades that only have a 2-to-1 or better reward to risk ratio. So let's talk about that. So let's just clarify real quick. We're talking about trading, not investing. There's a differentiation there. Trading typically has a defined time window, and that window, if you're day trading, could be minutes, hours, or if you're swing trading, position trading, days or weeks. But the time window and the time constraint definitely exist. So a trade does not have unlimited time to be right, so it does not have unlimited time to move up and pay out. So that's important to remember. Okay, so in terms of trying to get at least a 2-to-1 payout ratio, there's 3 rules. So the first rule is stop placement and position size. Absolutely essential. So if the loss isn't controlled, like I did on that spreadsheet, right, then the math just doesn't work. Because if you can take a large loss, it can wipe out a whole bunch of wins. So loss has to be controlled. So that's rule number 1, stop placement. And then the stops have to be at the correct place, and they define risk. And position size allows then for a meaningful upside. So episode 2, the one before this, I talked about how position size changes everything. and there's details in that, and there's a link to it at the end to go into more detail. You got to control the loss. You got to have your stops at the right place, and you got to have the right position size for the trade and for the account. All right. Only take trades with at least 2-to-1 potential, right? So the targets must be objective and observable on the charts, not where I want it to go, I think it will go, I wish it would go. It's some objective targets on the chart, right? Time and history must be respected, and the trade either has the structural time and room to pay at least 2-to-1 or it doesn't. So let's take a sidebar on that. All right. Oh, and by the way, that was a good statement, right? Hope is a beautiful thing. I hope, right? But it's not a strategy, not for trading and not for many things. Okay. So constraint number one here is time. We said trading is within some defined time window. So the shorter the time window, the shorter the time that the trade has to get into profit and to be bigger than the potential loss, right? The price just has less time and room to move, and time can cap the reward to risk before the trade ever starts. So it's important to be realistic within the time frame you're trading, that a legitimate target with that's 2-or-1 to better than the potential loss could be realized. And then history. Markets have memory. Repeated failure areas matter. Support, resistance, gaps, whatever indicators you're using, right? The market does have a memory. Those things matter. So it's important to respect them. If prices struggled to get through a price level before, that friction doesn't disappear. If it does break through, well, then that's a new scenario. But we have to go into a resistance area or a support area with the assumption that there's going to be another reversal like it did in the past as a conservative assessment when we're determining targets. All right, rule 3, let winners run. Winners can only be bigger than losers if they are allowed to be. Right? Cutting winners early, it breaks the math, right? That I just demonstrated on the spreadsheet. In order to be profitable, your winners have to be bigger than your losers. Otherwise, you have to have an incredibly high win rate, which is really hard to do. And if the stress is high in a trade, consider scaling out versus a full exit. And this may be one of the hardest parts of trading is when a trade is winning, we don't want to give it back. We want to capture the profit. We want to book the win. But the only way we can make the math of trading work is for the winner to be bigger than the losers. So we've got to let them run. And then so what this changes, you don't need to be right more often. You need losses to be controlled. They have to be capped because, one big loser can wipe out a whole bunch of winners. So let's keep them small. Winners have to be structured, right, by choosing legitimate targets, real targets, where the payoff, the profit could be larger than the potential loss, and then allowed, let them run to be larger. An average win rate can be very profitable. You can be profitable at 40, 50, 60% win rate. And we want to do better, but that takes the pressure off, right? And the pressure to win can be nearly unbearable. So let's relax. Let's make some profit in our trading. So that's a quick look at, why being right may not be enough. Put math on your side. Only take trades that have the potential to be bigger winners than they are losers. I suggest at least a 2-to-1 ratio. Bigger the better, of course. 3-to-1, 4-to-1. All right. There's links at the end. I mentioned episode 2 where we talk about position size. There's a link to that and the whole series and some other videos that you might find helpful. So I encourage you to check it out. All right. Thank you.